Welcome to the McEnulty Method. We're joining financial expert Frank McEnulty and Colin Sorrells to answer some of our questions about money and finance so that we can make better decisions. Today, Frank, there's something that's in the news, it's everywhere, interest rates. You're going to address it and let us know what is going on and why it's important to us.
They're going up. So if you owe money or are going to borrow money, it's important. But it's also important if you have a lot of money in the bank, right? You know, that one of the worst things that's happened over the last few years is that people that had saved their whole lives thinking, you know, I'll retire. I have $1 million in the bank. I can retire. It gives me an extra $50,000 a year at my 5% interest rate. I've been getting $2,500 a year instead of $50,000 a year because the interest rate was 0.25%, if that, for the bank. So, you know, it all depends on which way you're looking at it. Now, for buying real estate, rates are up, and that's what most people look at it. You know, how much is a house going to cost me? Well, how much that house is going to cost you is going to go up a lot right now because the interest rates have doubled, basically, or close to it. And, you know, on $100, interest rate doubling is not a big deal. On $500,000, $800,000, $1 million, an extra 2% a year on $1 million is an extra $20,000, which is almost $2,000 a month more on your payment. So I have a feeling the real estate business is going to slow down because people aren't going to be able to afford the houses, which isn't necessarily a bad thing. Because housing prices had gone crazy because rates were so low. What's the problem is right now is rates have zoomed up, but the market hasn't caught up with saying, oh, wait, if rates are up here, maybe prices need to come back down somewhat so people can afford them. So rates are up, but prices are up. So they haven't gotten the message yet that they're supposed to be going down. And I actually saw an article yesterday, and I don't know the exact numbers in it because I just glanced at it, but it said that real estate prices are starting to drop in quite a few markets. It even said in LA County, prices are starting to go down, which, you know, that's the canary in the coal mine there. So it will be interesting, but yes, interest rates are back up to where they last were in about 2008, 2009. So they've been down a long time. So a lot of people just think that, hey, 3% mortgage rate for 30 years is a normal number. Well, it's not. Think about it. If you're lending money to somebody at 3% for 30 years and inflation is 2% for 30 years, you're making 1% on your money. Quite honestly, anybody who is able to get a mortgage at these rates they've had out there has been extremely lucky. And they should never sell their house or never move or keep, because they're never going to replace that mortgage again. So like I said, it's a bad thing. It's a good thing. It just, like so much we talk about, right, Colin? It just depends.
You know, the stock market always seems to go crazy when interest rates go up or go down or whatever. Now that they're going back up, what is going to happen and why?
Well, and so yes, the stock market's going to have a big adjustment because interest rates were so low that people were putting money into a lot of stocks that they were hoping to get a return on. Notice I said hoping. A lot of startups, a lot of tech companies. I think the tech companies are going to have a very bad time of it over the next year because now all of a sudden it's not free money anymore. 1% is sort of free money, 2% sort of free money, 5-6% not free money. And so they have to start proving that they can make a return for people that actually matches what they could get elsewhere. Now, granted, the 3-year treasuries are, I believe, up, or the 1-year treasuries are up to 3%, or was it 10-year treasuries are up to 3%? Might be the 10 years that are up to 3%, because that's what mortgages are priced off of. Well, those were like a 1% not too long ago. So risk reward. I can get 3% buying a 10-year treasury bill, or I can invest in this risky startup. How much money do I need to make off of that? So that's why I think we're going to see a lot of tech stocks come down in value until they have earnings. Because remember, Bill, you were around in 2008 and that, or 2000, even better. Last, with the great tech wreck. What did people used to say about, a tech company? What was, one of their worst days was when they actually started making money. Because now they were going to be valued like a regular company. Well, before we were making money, we're valued on expectations. What they think we're going to make. Oh, we made a penny a share. Yeah, maybe we're not worth $100 a share. Because we made a penny on $100. So I think it's, I think it's good. I've said for a long time that mortgage rates are too low, that I thought a 6% mortgage rate was a rational mortgage rate. Now, I said that, and I'm in the process of trying to get a mortgage, so I'm sort of like, dummy, what did you say? But I really do think it's a reasonable rate. It provides investors a reasonable rate of return. I think it'll make the market much more rational. The market has not been rational. So I think it's going to be a good thing in the long run, because it's back to where the fundamentals will have more sway, rather than just the wild government spending and printing money that got us into this mess.
Well, I don't want to get too political about anything, but I did hear someone say that one way the government is going to help is to just tax us more and give us all more money. So take with one hand, give with the other. I wasn't clear on what they meant, but
yeah. So they're gonna take $100 from you, and then give you 60 back. And how does that help? Yes, I'm a very fiscal conservative when it comes to things, and so yeah, giving the government money never is a great solution. Now we need to give them money to operate the country and all that, but also, why do we have this inflation? Why are rates going up? Because we printed too much money. And there's too much money chasing stuff. Look, if the mouse here, if it was $5, everybody goes, okay, $5. $50, they say, I don't have enough money for that. But if everybody had 10 times as much money, $50, who cares? That's really what causes inflation. There's too much money chasing stuff. We created money without creating the goods that the money needs to buy. And so now, I say everybody's got all this money, and you're going to say, well, I don't have all this money. I don't have all this money. Colin doesn't have all this money. But there's a lot of extra money out there. And there's more money than we have stuff to buy. And we're Americans, so we like to buy.
You know what? That's our consumerism drives the world.
It does.
It does. We stop buying, it's all going to grind to a halt.
You know, even in Japan, their biggest problem is people save too much money.
You know, there's nothing worse than someone who is fiscally responsible.
There you go.
I think this bears, I think, a little more discussion, but we're a little bit out of time right now. So, and apparently you can't buy time with money, no matter how much you printed.
No, you can't.
But this would be a good topic for further discussion. And I'm sure there will be a lot in the news that will spur that discussion.